Hey everyone, thanks for tuning into today's session. I'm Anugrah, one of the founders at a small case. So recently we introduced futures and options filters in Screener. To access all these filters, you can come to the domain that you can see here. The URL is screener.smallcase.com and then just click on login with Kite. You need to provide your Kite credentials and you would be redirected to the Screener. At the left bottom side of the screener, you will see an add filter box. Just click on it and you will be able to access futures and options filter categories. Now, these filter categories consists of different types of filters. There are basic filters like open interest, prices, and contract sizes. You can see them all in the futures category here. There's open interest, there's lot size, there's future close price. Then we have calculated filters like 1 day and 1 week change in volumes and open interest levels. You can also see them. By hovering on any filter, you can also see a quick definition of the filter. Then we have derived filters like fair value spread, and cash and carry profit. We have some rollover filters also, given that the July expiry is coming in. You can check out these filters. It consists of filters like rollover cost and percentage rollover. And then we have more filters in the options category like strikes with highest call open interest and strikes with highest put open interest. Now, based on these filters, we have also created some premium screens for you. To access these premium screens, just click on all screens on the left top side and you will be able to see an FNO screen section. This consists of different premium screens like cash and carry candidates, future long build-up, future short build-up, and option long build-up. In this webinar, we will be specifically talking about cash and carry candidates. To access or open any of the premium screens, you can just click on the screen and you will see that the filters are loaded on the left selection panel and the results table is also updated with the current data. Now, before we go on and understand what are the results shown inside the cash and carry screen, the first and most important thing that we need to understand is what do we mean by arbitrage. Now, as the definition says, arbitrage means buying and selling of a particular security simultaneously in two different markets to lock a risk-free profit. It might get a little difficult to understand the definition in this format. So let's try to understand it with a very simple example. Suppose you want to buy 1 kg of oranges and the price of the 1 kg of oranges in Nagpur is 100 rupees and the price in Mumbai is, let's say, 200 rupees. So you see that the price difference between the oranges in Nagpur and Mumbai is 100 rupees. So there might be a profit opportunity here, but you're still not sure whether you'll be able to realize this profit or not. Now, in order to certain that you are able to realize some profit here, there are two things that you need to ensure. The first is that the quality of the oranges in Nagpur and Mumbai is the same, so that they are interchangeable. That is, you can buy from one market and sell the same thing in another market. And and the second thing that you need to ensure is that the cost of transportation of 1 kg of oranges from Nagpur to Bombay is not more than 100 rupees, which is the price differential between the two markets. Now, let's assume that the cost of transportation is rupees 50 between Nagpur and Mumbai. So the difference is rupees 100 and the cost of transportation is rupees 50. This means that there's a clear arbitrage opportunity to realize here. You can buy 1 kg of oranges from Nagpur, transport them to Bombay, incur a transportation cost of rupees 50, and then sell them in Mumbai at the cost of uh, rupees 200 per kg and realize a profit of rupees 50. Now, this is a very basic and crude example of arbitrage, which involves buying and selling of essentially the same underlying in two different markets simultaneously. Now, when you are doing this, you'll keep buying oranges from Nagpur and keep selling them in Mumbai in order to realize this rupees 50 profit on per kg of oranges. Now, when you're doing it, the demand for oranges in Nagpur will keep on increasing because you're buying more and more oranges from Nagpur. And the supply of oranges in Mumbai will keep on increasing because you are buying these oranges from Nagpur and you are supplying it in Mumbai. Now, and as the basic economic principle says, when the demand is increasing, price will go up, and when the supply is increasing, price will come down. So because you are buying more of oranges in Nagpur, the demand will keep on increasing for oranges in Nagpur and the price will start moving up from 100. And because you're supplying these oranges in Mumbai, the supply will keep on increasing, and thus the price will start dropping in the Mumbai market, and it'll start coming down from rupees 200. Now, suppose that the price, which started increasing in Nagpur and decreasing in Bombay, comes at rupees 150 in both the markets. Now, this is a price at which there's no scope for you to realize any profit, because the prices become equivalent in both the markets, and you'll actually incur additional cost if you start buying from Nagpur and incur some transportation cost and selling in Bombay. So these are the few basic concepts which were required to understand cash and carry arbitrage. Now, before we go on and check out what are the trades that you need to place, another thing that we need to understand is what do we mean by the fair value of a future contract. Now, to access fair value of any of the future contracts, just click on add filters, go to futures, and you will be able to see fair value. Like there's a filter called fair value. If you want to start from fresh, just click on the home icon. You'll see that the selection panel is cleared. Click on add filters, go to futures, and click on fair value. By doing that, you will see that the filter is added on the left side of the selection panel. Now, if you want to learn and understand any of the filters in more detail, you can click on read more about all filters at the bottom of the add filters window. Now, this will redirect you to our learning portal where we have explained all these filters in much more detail through easy to understand examples. So let's take the same example which we have explained here so that you can go back and check it out in detail for better understanding. So what's happening in this example is basically there are two ladies, Sita and Noor. Sita is trying to buy Noor's apartment, and what they have agreed for is that Sita will enter into a future contract with Noor to buy the house after 6 months for a consideration of rupees 1.1 crore. So basically, Sita has agreed to buy the house and hence holds the long position. Noor has agreed to sell the house and hence holds the short position. And the future price at the expiry that they have agreed to exchange is 1.1 crore rupees. Now let's directly jump to the fair value and understand what do we mean by this. Now, as we know that the price at which Sita agreed to buy the apartment from Noor 6 months down the line is 1.1 crore rupees. And let's assume that the current market price of the same 2 BHK apartment is 1 crore rupees. So this becomes the spot price in the market. And the risk-free interest rate, that is the interest rate with which Sita can realize by investing her money in any of the banks, is 6% per annum. And without going into complexities of compounding and compounding of returns, we can make a simple assumption that in next 6 months, if she decides to invest any amount of money today, she will be able to realize 3% of returns. So if Sita invests 1 crore rupees today in the bank, she will be able to realize 3% return and will have 1.03 crore rupees at the end of the 6 months. That is, this is what is written here, that if Sita invests rupees 1 crore in the bank today, she will have rupees 1.03 crore after 6 months, because the risk-free interest rate per annum right now for this particular bank is 6%. Now, this is called the fair value of the futures contract. Basically, a price where Sita would have been indifferent in buying the house today or after 6 months is the fair value of the particular contract or the underlying asset in the future contract. That is, if the spot price of any of the security or the commodity currently is X, and you decide to invest this X amount in the bank and earn risk-free interest rate, you will have, let's say, 1.03 in this example, 1.03x at the end of the 6 months. Now this becomes the fair value. That is, you are indifferent in giving X rupees today or 1.03x 6 months down the line, because that's sort of the risk-free return that you can anyways earn by giving your money to any of the banks. Now this becomes the fair value of any of the future contracts. So what we can infer from this discussion is that, simply put, fair value of any future contract is the amount that you will have at the maturity of the contract if you decide, or if you invest an amount equivalent to the current underlying price in the bank and earn the risk free rate. That is, for example, if you have a future contract on, let's say, Maruti, and the current stock price of Maruti is 100 rupees. So if you invest this current stock price of 100 rupees and hold it till the maturity in any of the banks, the price that you'll have in this case at the maturity becomes the fair value of the future contract right now. So this is how the fair value of the future contract is calculated. You can read the full example in more detail for better understanding. We, for all of our calculations on Skinner, we have taken 3-month MIBOR, uh, which is the Mumbai Interbank Offer Rate for the 3-month contracts that are traded as the risk-free rate. Now let's move back to Screener and check out the screen which we wanted to discuss. I go to all screens, I go to FNO screens section and click on cash and carry candidates. Now here I see that I have cash and carry profit, I have fair value, I have fair value spread. So there are few more terms which we need to understand before we'll be able to make some sense of what is happening in this screen. Because I'm seeing that cash and carry profit, which is an arbitrage profit for Tata Steel, is rupees 19,000. That is a risk-free profit of rupees 19,000 by putting a cash and carry trade on Tata Steel. So let's just check out few more details and understand the cash and carry arbitrage before we come back to this screen. So to do that, you can access this block which is available on Making a Small Talk uh, on the Medium. You can see the URL in the video itself and check it out later. Now, this is a live example to understand how you can execute a cash and carry arbitrage. What is happening is that on 3rd of July, Nestle India was trading on the NSE at a price of rupees 3,637.2 per share. The company shares also gets traded on the futures counter. Now, given that we are in the month of July and it was 3rd of July when this example was written, the near month future contract was the contract which was supposed to get expired on 27th of July. So that becomes the near month future contract, and the price of that contract on the same day was 3,713.85 rupees. The lot size of the company in futures market is 200. What do we mean by lot size? Is basically the total number of shares considered in the one lot of the futures contract. And for in this example, we have assumed that the risk-free rate is 6.55% per annum. So let's just quickly recap all the information which is available to us. That is, the spot price of Nestle India on 3rd of July is 3637.2, which I have highlighted for you. Similarly, future price of Nestle India is 3713.85. Days to expiry, that is the time difference between the 3rd of July and the 27th of July when the future contract will get expired, is 24 days. And the lot size for Nestle India is 200 shares. So let's now go back to our understanding of fair value of a futures contract and see what was the fair value of Nestle's future contract on 3rd of July. Now, as I mentioned in the apartment example which we just discussed, fair value for easy understanding can be considered as the price that you will get at the maturity if you decide to invest spot price today and earn the risk-free rate. So that's how we have calculated the fair value in this example also. You can see that the spot price is 3637.2, and we are calculating the interest that we will be earning if we invest this spot price for next 24 days and earn an interest of 6.55% per annum. So the fair value of the future contract is calculated as 3653.12. So till now we have three different prices available to us. One is the spot price, that is the price of the Nestle shares in the cash segment. Then we have the future price, which is the price of the Nestle's future contract, and then we have the fair value for the Nestle's future contract. The next thing that we calculate is the fair value spread. Now, the fair value spread is defined as future price minus futures fair value. So the current future price is 3713.85, which was given to us, as we can see here, that the future price at the end of the day was 3713.85. And the fair value price that we calculated from our formula was 3653.12. So the difference between the future price and the fair value price was 60.73. Now this is called the fair value spread. Now to easily understand what's happening here is that the current price of the futures contract is higher than the fair value of the future contract. Now, what we established for fair value of a future contract was that a price which makes the long position holder of the future contracts indifferent in buying it today or buying it at the maturity, because he can earn the risk free rate by investing the current spot price in any of the banks. So in this case, the futures right now is a little expensive compared to the fair value. And whenever a particular contract or security is trading at a higher price compared to the fair value of the same contract, we need to go short on the same security in order to make some profit. So whenever the fair value spread is positive, that is the current future price is more than the fair value of the future price, the for to execute an cash and carry arbitrage, you will have to open a short position into the futures contract. So now let's just see what are the different positions that we will be opening in order to execute this cash and carry arbitrage. Now first, the trader buys, that is goes long on 200 shares of Nestle India at the current price. Why 200? Because the lot size of the Nestle's future contract is also 200, and what we need to do is to ensure that we have the same number of quantities of the Nestle shares on both the sides. So given that we established that the fair value spread is positive, so we would be opening a short position on the futures contract of Nestle. Simultaneously, we would be opening a long position on the Nestle share price in cash. And given that the lot size of the future contract is 200 shares, we need to buy the same quantity in cash to offset the position. So the first trade was short one contract of Nestle's future, and the second trade was go long on 200 shares of Nestle future. Now let's assume that uh, the user who's trying to execute this particular trade doesn't have money to buy the Nestle shares. So in this case, what he can do is he can go to the bank and borrow some money to invest into this particular share. So for example, that day's closing price of Nestle was 3637.2, and if you wanted to buy 200 shares, it would have cost you somewhere around 7,27,440 rupees. Now let's assume the trader borrowed this amount from the bank to invest in the stock, and at the same time he is going short on one Nestle India's future contract. So he so a trader who's trying to put a cash and carry arbitrage trade on the Nestle on 3rd of July is basically doing three things. He's going to the bank and borrowing some money to invest in the stock. That is the first thing. Second, he is opening a long position in the stocks where the quantity is equal to the lot size that of the future contract. And the third thing is that he is opening a short position in the future contract. Now let's see what happens at the expiry if the trader is putting all these trades. Another assumption for cash and carry arbitrage is that all the trades placed will be held till the maturity. And at the maturity, the price of the spot and the price of the future contract is always the same. So the trader has two positions: long position in the future contract, long position in the shares, and short position in the future contract. So let's take two different cases. In the first case, let's suppose on the day of future expiration, that is 27th of July, the stock is trading at rupees 3,800. So the profit on the long position is 3,800 minus the price at which the trader bought all the shares. That is the closing price or the spot price of 3rd of July, which is 3637.2 multiplied by 200, because this is the number of shares that he had bought. So the profit on long position in this case would be close to rupees 32,500. Now simultaneously he will incur a loss on the short position, and the loss on the short position will be the price at which he opened the short position, which is 3713.85, and the price at the expiration, which is 3,800 multiplied by 200. So he will incur a loss of rupees 17,230 on the short position in the futures contract. So the total combined profit and loss on the long as well as short position would be rupees 15,330. But at the same time, we know that the trader had borrowed this money from the bank to invest into the transaction. So he would have obviously incurred some interest cost. So what is that interest cost? If the risk-free rate was 6.55% is calculated here, this is equivalent to 3,183. So the total profit, which is the profit on the long position, loss on the short position, and the cost of borrowing funds to invest into the spot shares, is equivalent to rupees 12,146.57, which you can see at the end, and I've highlighted it for you. So in case one, when the securities price goes up from 3,637.2 on 3rd of July to 3,800 at the expiration, that is on 27th of July, the trader made a total profit of 12,146.57 by putting a cash and carry arbitrage trade. What did he do in the trade? Is that he opened a short position on the future contract, he opened a long position in the cash segment by buying 200 shares of Nestle, and he borrowed the money to invest or basically buy these 200 shares, and thus incurred a interest cost on the same. Now let's take the second case and assume that the price drops instead of increasing. So in the first case, the price increased from approximately 3,600 rupees to 3,800 rupees. In this case, let's assume the price decreases from 3,637.2 to 3,400 rupees. So when the price is decreasing, the trader will obviously incur a loss on the long position. And in this case, the loss would be rupees 47,440, which is calculated in the first step. Now, given that the price is decreasing, he'll make a profit on the short position. And the profit in the short position in this case would be rupees 62,770 rupees. So the combined profit and loss on the short and the long leg of the trade would be rupees 50,330. Now, given that he had borrowed the money to invest or buy 200 shares of Nestle, again there would be a cost, or that is the interest cost that he would have to pay to the bank at the end of the maturity. And in this case also it would be the same cost, which is 3,183.43. So again, the total combined profit and loss for the trader, if you observe, is 12,146.57, which is the same profit and loss which we observed in the first case. So irrespective of the fact that whether the price increased or decreased, trader was able to realize the same amount of profit by putting a cash and carry arbitrage trade on Nestle on 3rd of July. So this is how a cash and carry arbitrage trade is executed, but there is also a very easy and quick way of calculating how much profit can be realized by putting a cash and carry arbitrage trade. If you remember, the first thing that we calculated to ensure whether there is a cash and carry arbitrage opportunity was to find out fair value spread. And we defined fair value spread as the difference between the future price and the fair value, and in this case it was 60.73. So if you multiply this fair value spread directly by the lot size, you will see that you will be able to calculate the cash and carry arbitrage profit in just one step. That is 60.73 multiplied by 200, it is equal to 12,146, which was the cash and carry arbitrage profit in both the cases. So quickly recapping the example that we discussed, first thing to establish in order to find out whether there is an arbitrage opportunity is to calculate fair value. The second step is to identify what is the difference between the fair value and the current traded price of the future contract. If the current traded price of the future contract is more than the fair value, that is the fair value spread is positive, then there is an cash and carry arbitrage opportunity. Given that the price of the future contract was more than the fair value, we need to short the future contract at this, and simultaneously we need to open a long position in the spot market by buying a quantity which is equal to the lot size of the future contract. And if we do this, then irrespective of the movement in the price of the security, we would always be able to make a risk free profit at the end of the maturity. Now, given that we have understood what we mean by arbitrage, fair value, and how can we place cash and carry trade, now let's go back to the screener and explore our cash and carry candidate screen in more detail. Now, I'd already preloaded by going to all screens and selecting cash and carry candidates. Now here you can see that all these stocks are arranged in the decreasing order of profit that can be realized by placing a cash and carry arbitrage trade. That is, the important thing to note here is that all the data that we are showing is end of day close yesterday. So end of day close yesterday, the fair value spread for Tata Steel was 9.6. So this is the first thing that we calculate. That is the difference between the fair value and the futures traded price. Given that this is positive, so there is a cash and carry arbitrage opportunity. Now I told you that the very easy way of calculating the cash and carry profit is to multiply fair value spread directly by the lot size, and in this case you will see that the cash and carry profit is 19,210.2. Now the important thing to remember here is that we have assumed a risk-free rate of 3-month MIBOR. Like what is the level of 3-month MIBOR at the end of the yesterday is going into calculating all these figures. You can rearrange all the stocks on the basis of fair value spread also. So you can see that the fair value spread is highest for Syntax Industries right now. Sorry. Yeah. Yeah. So you can see that the fair value spread is highest for Shree Cement right now, and this spread is 30.4. If I want to cross check whether the cash and carry profit by shown here is equal to multiplying this fair value spread by lot size, I can go to add filters, go to futures and add lot size. I see that the lot size for Shree Cement is 50. So if I multiply this lot size of 50 by the current fair value spread, that is the cash and carry profit that I'll be able to realize. So this screen gives you a very quick view about what are the potential candidates on which you can place a cash and carry arbitrage trade. That is where the fair value spread is positive, and at the same time it also shows you the profit that can be realized by placing these trades, and this profit is simply the fair value spread multiplied by the lot size. So that's it for today's session. Thanks a lot for tuning in.